Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to part 2 of my multi-part video series called Financial and Retirement Planning Calculator Full Build-Out. In this video, we're going to continue walking step by step through the build-out of a financial and retirement planning calculator that will be based on the following roadmap. So if we look down here again in our pre-retirement calculations, in video number 1, we finished step 1 right here, which was to calculate our current net worth as of today, or more precisely as of 12/31 of the prior year. Now here in video number 2, we are going to begin the process of going through step number 2 right here, which is to calculate our after-tax cash flow for the current year. And to accomplish that, let's start with the basic walkthrough of what the structure of our cash flow projector for pre-retirement purposes is going to look like. In this example, the current year is going to be 2024, and we're going to need to know both the age of the individuals involved in the calculator, whether that's one person or two. We are also going to need to know the retirement age of one or both of the individuals involved in the calculator. We said we would define the age initially, and then as we move further along in this process, we will make this dynamic. So this age can be changed, and the entire calculator will update accordingly. However, as I said in video 1, we just need to pick some age to get started. Now let's start walking through section 1 of the cash flow projector right here, which is going to be our taxable income projection before tax deferral. And as you know, that means before we choose the amounts that we are going to defer on a pre-tax basis to account types such as 401ks and traditional IRAs. Okay, so the first income type that we will include in the calculator is going to be employment income from W-2 wages. I have 2 lines for each spouse, and as you know, for many people in their pre-retirement years, this will be their primary source of income. Okay, next on the list will be our investment income. This is a Schedule B item from your tax return, and this relates to our taxable cash and brokerage accounts. Now, if you watched video number 1, all of the descriptions that you see right here should look familiar. In fact, if we go back over here to our net worth projector, you will see all of the same accounts right here at the top. These are our non-tax advantaged regular cash and brokerage account types, all in this list right here. And the exact items that are in this list are going to be the same items that are in this list right here. Because if we go back over here, this interest and dividend and capital gain distribution income, which is in the list right here, is going to be a taxable item each year that is included in the projector. So after we determine what the actual or projected amount is going to be within the net worth calculator, we are going to have to carry those numbers over here to the equivalent year in order for them to be taxed. And once we start linking up the net worth projector to the cash flow projector, we will see how all of that is going to work right here. Next on the list is going to be our self-employment Schedule C income. This is if you have your own business or you have a business where you receive a 1099 NEC from a third party. And that would be the case if you work as an independent contractor rather than an employee. After that, we're going to have our capital gain income, which is a Schedule D item. These are the account types for which a capital gain is possible right here. And again, if we go back over to the net worth projector, you will recall that for these account types starting right here to the bottom, these are the ones for which we left open the spot to put a realized capital gain. We had grayed out the spot for capital gain up here in the cash account section because there is no market return related to cash accounts. We had also grayed out the capital gain section down here in the tax deferred account types, whether those were for investment accounts or special purpose accounts, or even our after-tax investment accounts, generally like our Roth types of accounts. In these types of tax-advantaged accounts, as you know, there is no such concept as a capital gain. All of the gains and losses and income items remain inside of these account types from a tax perspective, and the only time there is a taxable event is when you have a distribution from the account types. So for that reason, we have limited the capital gain income section to just these particular account types right here. Now, in addition to that, it is also possible to have capital gain on non-portfolio types of assets, such as real and personal property. All of that would also go on Schedule D, and I'm going to put that down here in its own little section right there. Next on the list, we have our Schedule E items. So this is going to start with our rental property income. We also have royalty property income right here. Also on Schedule E will be flow-through income from partnership interests, as well as S corporation interests. These are the types of income that you will receive on a Form 1065-K1 or a Form 1120-SK1 in the case of an S corporation. After that, we have our farming and agricultural income. Those are Schedule F items. And then finally, we have a catch-all bucket for other types of taxable income that you may have: alimony received, gambling, unemployment, and then a bunch of placeholders just in case there are some items contained within your specific fact pattern that don't fit appropriately in any of these other categories above. And so when we sum up all of those different types of income, that is how we will arrive at taxable income before income deferral into our pre-tax investment accounts. Okay, continuing down the list here into section 2, now we have our pre-tax income deferral items, and this section is going to be used both for the deferral, in other words the tax deduction, as well as the distribution, in other words the taxation later on, for money that is going in and out of these types of accounts. Now again, as you look on the list here, you will notice that these are the same accounts in the same order as was presented in video 1 on the net worth projector. In fact, if I go back over here to the net worth projector tab, you can see our investment accounts, the pre-tax deferred ones, all listed right here in this section. So the way that this will work within the calculator is that when money goes into one of these accounts, first off, it will be a deduction in the current year. That is why this section right here is presented before the section where we calculate income tax, which is going to be down here in section 3. In addition to that, when there is a contribution here, the value of that contribution will be taken over to the net worth projector tab, and it's going to go right here into this column, the free cash flow allocation to net worth. The value of the items, as we went over in video 1, will increase our net worth by going into this column for the pre-tax accounts right here. Alternatively, when we have a distribution from this kind of an account, that distribution also needs to go up here in the section before we calculate our tax, because as you know, and as we've mentioned several times already, distributions from these types of accounts will be taxable items, so they'll have to be listed here in order to be taxed. Now that's going to be slightly different down here in our special purpose accounts that are tax deferred, such as our HSA accounts. Contributions to HSAs, which are tax deductible, will go in this section right here prior to the tax calculation. However, distributions from those types of special purpose accounts will not go here, generally speaking, because as long as those distributions are used for the intended purpose of what the account was created for, in other words, medical or health-related expenses in the case of an HSA, then those distributions are not taxable, and therefore they would not go right here above the tax calculation. Instead, we will find a place for those further down after the tax calculation is complete. Those will represent distributions from our net worth that will go against expenses down in the personal expenses section, which is going to be further down on the page here. And when they offset those expenses, there will be no income tax effect. Okay, now we're going to move on to section number 3 here, and this is where we're actually going to calculate our tax, but more specifically, we're going to determine our after-tax cash flow before considering personal expenses. Now, this is going to make a lot more sense when we come back here and actually throw some numbers in here so we can see the calculations. So for the moment, as we're just setting up the structure of the calculator, let's just run through the line items real quick, and then we'll come back with some numbers and finish this out. So first we'll have our taxable income after the tax deferral that we did in the last section. Then we'll have our standard or itemized deduction. This first line minus this line will result in our taxable income. To that we will apply an effective tax rate, which we will build out later, and that will result in our income tax. So then when we take our taxable income after the tax deferral from up here and we subtract off our income tax, we're going to get our after-tax cash flow before considering non-taxable income. Now, examples of non-taxable income can include tax-exempt interest income, for example, from municipal bonds, gift income that you receive, child support that you receive, and when we add those non-taxable income items in, we arrive at an after-tax cash flow after considering non-taxable income. Now, I have put in 2 line items here where we are going to remove from this calculation investment income as well as capital gain income, because investment income is going to be tracked and handled on the net worth projector. We're only bringing it over here for purposes of calculating tax. And the same thing is going to be true with this capital gain income. Remember, capital gain is just a tax recognition event. The actual gain itself is still going to be handled and included on the net worth projector over here. So once we remove those items, we will be at an after-tax cash flow before considering our personal expenses, and that is where we are going to start section 4. Okay, in section number 4, we are going to look at our after-tax cash flow allocation to personal expenses. Now, I have a huge list of possible personal expenses coming up just below here. So since we're not using numbers, I'm just going to go through them high level. We're not going to spend too much time on this section right now. We will spend more time when we bring in the actual numbers in a little bit. So the first couple of sections will deal with housing expenses, and I have broken it up between mortgage, which by the way I have further broken up between principal and interest, and we will see the difference in how those are treated in a little bit. Then we're going to have housing expenses related to rental properties if you happen to rent and not own. Then we're going to have all of our general housing expenses down here. After that, we will deal with housing expenses related to utilities. Then we're going to move on to vehicle expenses, and again, with respect to the loan on a vehicle, we are going to break it out between principal and interest. Down here we will have other vehicle expenses, and following that we will deal with other types of term loans, again broken out between principal and interest. These can include personal loans, student loans, and any other kind of loans that are term loans, not revolving loans like credit card debt, but term loans similar to loans that you would take on a piece of property or a vehicle or a student loan, etc. After that, we're going to get into various kinds of insurance that you may have, and then healthcare expenses after that. In the healthcare expenses section, we are going to have a place down here for an HSA or an FSA reduction. This is where money is going to come out of those special purpose accounts to be used against and to offset various kinds of healthcare expenses. Following that, we will deal with childcare expenses, and I've broken it out into 2 sections, one where children are still living at home, and then down here when children are off to college and the costs associated with that. Also in this section related to education, we will have our 529 plan reduction section, and this is conceptually similar to our HSAs, for example, when the money comes out of a 529 plan and it is used for the purpose for which the plan was established, in other words for higher education, then those distributions are tax-free. So we will deal with the details of that when we get down here into this section with some numbers. Following that, we're going to budget for various kinds of food, meals, and entertainment. Then we're going to deal with personal care. Following that, we're going to deal with the costs of family's best friend, including pet purchases, pet food, and so on. We will also have a place for large purchases that go against current year income, and then finally a catch-all bucket for other expenses not appropriately categorized above. It could be alimony that you pay, dues, charitables, bank fees, guests, i.e. entertaining, birthdays, gifts to others in cash, and some other placeholders to get all the way down here to total expenses. Part of figuring out our net worth and planning for retirement and planning for the future is to lay out a budget, and that is what we just went through above, and we will go through above again with some numbers which we will then not only figure out for this year, but we will project into the future. I will also note that we are still currently working on the cash flow projector for pre-retirement purposes. When we start to make the cash flow projector for post-retirement purposes, it is likely that a variety of the expenses that are listed on here will change, because after all, there are a number of expenses on here that are generally more applicable to those in pre-retirement years, and then there will be a whole variety of expenses as well as income items such as Social Security, pensions, and so forth that are more applicable to folks in their post-retirement years. But for now, since we're working on pre-retirement, we have a pretty good list with a variety of placeholders that should be able to cover everything in your budget. So once we figure out all the total expenses for the year and we subtract it from that after-tax cash flow figure from above, we will finally arrive at our after-tax cash flow after personal expenses, but before the allocation of what remains to our net worth. Okay, so let's drop some numbers in here so that our allocation to net worth makes a little bit more sense when we can actually see where the numbers are going as opposed to just talking about it qualitatively. So let's get our bearings here. This is going to be the current year 2024 in this example. If I go back over to the net worth projector, recall that we started for this example with the market value at 12/31/2023, and we are working on the market value at 12/31/2024. And therefore the current year's income and free cash flow after tax and after expenses is going to be the amount for 2024 for purposes of this column right here over on the net worth projector. Now the first bit of functionality that I want you to be able to see in the calculator is after we work on the current year right here, we basically close out whatever values we have into our net worth in this column, and we get an ending value over here for whatever year we're working on. But after this year is complete and it's time to start working on 2025, for example, we no longer need this year in the pre-retirement cash flow projector anymore. And then after we work on 2025 and 2025 is complete, we won't need that year anymore. In fact, what we want to see is that the number of years being calculated out to the year of retirement will decrease by one, by one, by one, by one, all the way to the point where the current age of the individuals within the calculator is equivalent to the retirement age of the individuals within the calculator. So for example, we have one spouse at 45 and one spouse at 42 right here. We also have a retirement age of 65 and 61. So if you look over here, you can see that the calculations are extending beyond what we can currently see on the screen right here, because the retirement age is in excess of these ages over here in 2039. In fact, let's scroll over a little bit to the right and see in what year the calculation stops. Okay, so I had to make the screen just a little bit smaller for the moment just so we can see everything in one place. But if you look over here, we have a retirement age again, 65 and 61. So the calculation is going to stop with respect to spouse 2 in 2044, and then it will stop with respect to spouse 1 in 2045. So as of 2045 in this fact pattern, the couple is retired. Now, of course, we can change the ages for purposes of our projection. We can change the retirement ages, but as things are set up at the moment, retirement occurs in 2045, and then we will switch over from the pre-retirement cash flow projector to the post-retirement cash flow projector that we will build out in a future video. So let's keep this year in mind for a minute, 2045. I'm going to make the screen bigger and go back to where we were. So now what we're going to do is increase the age of these individuals, and then we're going to watch the number of years in the calculation decrease by one, by one, by one, by one, until we hit the retirement age, and then there should just be 1 year left in the final year before we retire. Now, for the moment, I'm going to increase this just using a cell right here, but later on we will connect this to the command center once we build that out. So I'm going to use this cell. I'm just going to add 5 more years. So you should see this year go up by 5, this age go up by 5, and this age go up by 5. Okay, so this is assuming now that we are working in 2029, spouse 1 has turned 50 and spouse 2 has turned 47. You can see over here that the retirement years are starting to become visible on the screen. Now let's go back over here. I'm going to make this 6. I'm going to go in here. Let's just make it 10 to speed this up. I'm going to make this 12. I'm going to make this 15. I'm going to make this 19. And now you can see that we are only down to 2 years left inside the pre-retirement calculator before we retire. Now, I want to make sure it's clear what we're doing here from a conceptual perspective. So let's go over here to this concept check. All right, so we're here in the concept check. Now let's pretend for purposes of this example that this row here at the top represents the first year that you're using the calculator. And let's further assume that as of today, we have a net worth of $100,000. We're projecting 5 more years until retirement. And after we go through all of the calculations in the cash flow projector, the very last number, the free cash flow that we finally arrive at, the amount that's going to increase our net worth, is going to be $50,000 a year each year for 5 years, resulting in a projected net worth at retirement of $350,000. Now, obviously, there's going to be a lot more that goes into this calculation, and these numbers are not going to be nice round numbers like they are here, but this is just a concept check to make sure we understand what's happening. So now that we have completed the projection as of the end of year 1 as to what the retirement net worth will be, we go down over here to start the projection for year 2. Now let's ask this question. As of the end of year 1 up here, what was the net worth that we projected for the beginning of year 2? Well, it was the sum of this plus this, right? It was the $100,000 of actual net worth as of today, plus the $50,000 of projection for the first year would have been $150,000. But then right before we start the year 2 calculation, we gather up all of our brokerage statements, all of our bank statements, we take a look at the value of our properties and so forth, and we determine that our actual net worth starting in year 2 was $145,000. Not the $150,000 that we were projecting as of year 1. And so what we do at the beginning of year 2 is we refresh the starting point from a projection to an actual number based on our actual net worth. And then from there, we continue to project for the remaining years between today, which is now year 2, through the retirement year. In this example, there are 4 years left. We also adjust our projection based on any facts and circumstances that may have occurred in our life. For example, let's say we got a raise at work, or our investments have a better return associated with them, or whatever the reason may be, we are now projecting an annual increase to our net worth of $60,000 a year for the next 4 years instead of $50,000 in the previous projection. And so based on our refreshed starting point plus our revised projections for the remaining time, we end up with a new projected retirement net worth of $385,000. And then the process just continues in the same fashion until we reach retirement. So for example, as of year 2, we were projecting 145 plus 60, which is 205, to be our net worth at the end of year 2. But when we get to the start of year 3, we determine that it's not 205, it's actually 215. So we refresh the starting point here. Let's say we're expecting $60,000, but we're also expecting a big bonus, maybe a $40,000 bonus. So that gets included in here. Now we have a $100,000 net worth increase projected for year 3. We remain at at $60,000 for the subsequent 2 years, resulting in a projected net worth at retirement as of year 3 of $435,000. Then down here in year 4, we look back and say, okay, we were projecting $215,000 plus $100 is $315,000 for this starting point, but you know what? It's actually only $300,000 for whatever reason. So we refresh this to actual. We project for the remaining years between now and retirement. We determine that as of year 4, our retirement projected net worth is going to be $400,000. And then the process just keeps going, knocking off a year until we get to retirement. That is what we just went through over here in the cash flow projector, where we knocked off year after year after year after year until we got down here to our retirement age. Now let's say back over here on the concept check, we're looking at this and saying, you know what, I don't like $400,000 as my projected value, my projected net worth at retirement. That's not enough. Maybe I want more than that. And so let's just assume that right here we're working conceptually with the same example as in the concept check. So we could certainly go down the list and look at all of our income items and all of our expense items and say, what can I adjust? What expenses can I reduce? What income can I increase? And so on and so forth, to see if I can hit my net worth at retirement goal. But what's another thing we can do? Let's say you can't increase your income or you can't reduce your expenses for whatever reason. What else could you do? Well, we could go back over here to the retirement age that we previously defined and say, you know what, instead of 65, maybe I'm going to change this to 67. And when we do that, you can see that the calculation starts populating again for 2 more years. Because as I'm sure you can tell, the decision to calculate is based on the difference between whatever the current age is, which obviously we can't change, but we can change what our projected retirement age is if necessary, if we don't like what the projection is looking like the closer and the closer we get to that retirement age. So if we go back to the concept check, that's like saying, all right, I've looked at this projection, I'm at a $300,000 net worth actual. I'm projecting 2 more years at $50,000. I'm seeing $400,000 projected at retirement. I don't really like that. It's not working well with my retirement plans and goals and whatnot. I'm looking at my income and expenses. I don't really see a lot of area to change those over the next couple of years, so I've decided I'm going to work 2 years longer. So now I have a revised projection as of year 4 right here. It's going to be the same $300 actual net worth. We can't change that. That's what we're actually worth at that point in time. I'll still have this $50,000 projected. I'll still have this $50,000 projected. But now I'm going to tack on 2 more years at $50,000 increases, resulting in a revised net worth at retirement 2 years later at $500,000, which should work better with my retirement plans and goals and what the net worth and cash flow projectors are showing on a post-retirement basis, which we will get to in a future video, the amount of money that I'm going to need in retirement and so forth. Let's just assume in this fact pattern that this works better for us than this up here. And so that's what we've accomplished by doing this. All right, I'm going to go in here. I'm going to put this back to our original example like that. And that is going to be it for this video. In video number 3, we are going to start to comb line by line through this column right here for the current year. We're going to start talking about where numbers come from and how they interplay with the net worth projector. Some of the numbers in this column will come from the net worth projector. For example, all of these interest and dividend items right here. If I add these up, we see there's a total of $10,420. Well, these come from over here on the net worth projector, right here in this interest, dividend, and capital gain distribution income column that we set up in the previous video. Right there is the same $10,420. The reason we're carrying them up here to the cash flow projector is because they have to be taxed. If we look back over here, this projected income is on a pre-tax basis in these portfolios, so we have to take take it over here, tax it, and then ultimately bring the after-tax free cash flow back over here when we're done going through our income and expenses. We will also have items in this column that go directly from the cash flow projector over to the net worth projector. For example, right here we have a $10,000 pre-tax contribution to a 401k. Well, that $10,000 needs to come right over here and be included in this 401k account so it can ultimately be included in our net worth. And then back over here on the cash flow projector, we will walk through our tax calculation right here. We will start allocating our after-tax cash flow to all of our personal expenses down here in all of these sections. And ultimately, we will arrive at an after-tax cash flow before the allocation to our net worth, which will occur down here in section 5. For example, right now we have $32,235 left to allocate. And for the moment, I've kept it pretty straightforward. We have a $5,000 contribution to a Roth IRA, and the remaining $27,235 has been allocated to checking 1. So when we go back over here to the net worth projector and I scroll down, there's our $5,000 Roth IRA contribution. And then if I scroll up all the way back to the top, we can see our allocation of $27,235 right here in checking 1. So lots to cover in video 3. That's going to be it for today, and I will see you in the next video.